Welcome back to the deep dive. Today is Friday, February 13th, 2026. And look, I am not usually one for superstition.
Uh-oh.
Yeah, I don't mind black cats crossing my path. I don't mind walking under ladders. But considering the company we are unpacking today, the date feels a little bit on the nose. It feels heavy.
It does feel slightly ominous, doesn't it?
Mhm.
There is a certain, weight to the air today.
There is, because we aren't just looking at a tech company. We are looking at a company that is quite literally the operating system for the global economy.
Mm-hmm.
I mean, if you are wearing sneakers right now, if you drank a coffee this morning, if you drove a car to work, odds are the supply chain that got those things to you was managed, tracked, and invoiced by SAP.
Ticker symbol SAP.
Absolutely. That term they use, the operating system for global business, isn't just marketing fluff. It's the reality. Their systems touch something like, 87% of total global commerce? It is the invisible nervous system of capitalism.
Right.
If SAP goes down, the world stops shipping things. It's that simple.
Yeah.
Which brings us to the core tension of today's dive. Usually, when we talk about a business that owns the nervous system of the world, we're talking about a buy and hold forever stock, a safe haven, a fortress.
You'd think so.
But you've brought a stack of research today that suggests otherwise. You're arguing that despite being a great business in the history books, it might be a dangerous stock to buy right now.
That is the crucial distinction we have to make today. A great company is not always a great investment. Valuation matters. Context matters. And for this deep dive, we are going to apply a very specific, somewhat aggressive lens to SAP.
Okay.
We call it the skeptical buy-side framework.
I love the sound of that, skeptical buy-side framework.
Mm.
It sounds expensive and rigorous. What does it actually mean for the listener?
It's a mindset shift. It means we stop acting like fans of the brand. We stop looking at the glossy marketing slides and the, Vision 2030 statements.
Cut through the noise.
Exactly. Instead, we treat the stock as guilty until proven innocent.
Okay.
We are stress testing the thesis. We are looking for the cracks in the foundation, specifically because SAP is in the middle of this massive, messy, difficult transition from the old world of on-premise software to the cloud.
So we're kicking the tires.
We are kicking the tires, and we are kicking them hard.
Guilty until proven innocent. I like it. Let's put them on trial. Because if I just look at the headlines, the defendant looks innocent. In fact, the defendant looks fantastic.
Mm-hmm.
I'm looking at the fiscal year 2025 numbers here. Operating profit is up 111%.
The magic number.
If I saw a 111% jump in my portfolio, I wouldn't be skeptical. I'd be ordering a yacht.
And that is exactly why the framework is necessary. Because beneath that 111% number and beneath the revenue growth, there are what we call disconfirming data points.
Okay.
There are signals, specifically regarding the cloud backlog and regulatory threats, that have the market very, very nervous. The headline is shouting success, but the footnotes are whispering caution.
Okay, so set the roadmap for us. How do we dismantle this beast?
We're going to do this in 4 distinct acts. First, we need to expose the economic reality. We need to explain why that 111% profit jump is, something of an optical illusion and what the business actually looks like today.
Got it.
Second, we're going deep into the cloud transition. There's a specific metric called the backlog that is flashing red, and we need to understand why.
And after that?
Third, we're going to look at the moat. How sticky is this software really? And we'll talk about the regulators who are trying to fill that moat with concrete.
Oh, that sounds juicy.
And finally, Act 4, governance. We need to talk about where the cash is going and whether we can actually trust the numbers management is giving us.
Let's do it. Let's start with Act 1, the economic reality. Paint the picture of where SAP stands today, early in 2026. What is the scale of this machine?
To understand the money, you have to understand the sheer size of the engine. SAP made $36.8 billion in revenue in fiscal year 2025.
$36.8 billion. That's a staggering amount of money.
It is. But the composition of that money is changing rapidly. About $21 billion of that is now cloud revenue.
Okay, so the cloud is the big driver now. It's flipped.
It is becoming the dominant force. It's growing somewhere between 23% and 26%, depending on the currency adjustments. That's the growth engine.
Okay.
But, and this is the key, they still have this massive legacy tail. This is the support and license fees for the old software installed on physical servers in basements around the world.
The old school stuff.
The old school stuff. That part is shrinking intentionally, but here's the secret. It is incredibly profitable.
Right, because the software was built 20 years ago. The R&D is done. It's just pure margin at this point.
Exactly. It's like owning an apartment building that you paid off in 1990. Every rent check is pure profit. It's 90% margin in some cases. It's just free money.
Wow.
Now, keep that in mind as we look at that headline profit number you mentioned. IFRS operating profit up 111% to $9.83 billion.
Sounds miraculous, like they suddenly figured out how to print money or discovered a gold mine under the headquarters.
But they didn't. And this is what we're calling the profitability mirage. If you dig into the footnotes, which we always do, you see that this jump wasn't primarily driven by selling more software.
So what was it then?
It was driven by a lack of spending on restructuring.
Let's unpack that. What does that mean in plain English?
Think back to 2024. SAP launched a massive transformation program. They were firing people, they were closing offices, they were severing contracts.
A big cleanup.
A huge cleanup. And it cost them roughly $3 billion in 2024. That $3 billion was an expense line item, dragging profit down significantly that year.
Okay, so 2024 was artificially low because of all those one-time costs.
Correct. Now, come to 2025, they didn't have that expense. They stopped the restructuring program. So suddenly you have $3 billion reappear on the bottom line. It looks like profit growth, but really it's just the absence of a one-time cost. They didn't make $3 billion more. They just spent $3 billion less on severance packages.
So it's not that the car engine got twice as powerful. It's just that they stopped paying the mechanic to rebuild it.
Precisely. That is the perfect analogy. And if you look at the non-IFRS profit, which strips out those one-time costs to try and show the real business health, it was up 28% to $10.42 billion.
Okay, well, 28% is still pretty good, isn't it? I'd take a 28% raise.
It is healthy. I'm not saying the business is failing. A 28% rise in operating profit for a company this mature is impressive. But there is a massive difference between the narrative of we doubled our profit, we are exploding, and we had a solid 28% growth year.
Right.
The market prices companies based on the narrative. And if the narrative is inflated by accounting mechanics, the stock price might be inflated too.
And this brings up to the bigger strategic picture.
Yeah.
You mentioned the shift from the basement servers to the cloud. This isn't just a technical upgrade, right?
Yeah.
This is a fundamental change in how they make money.
It's a total business model transplant.
Yeah.
You have to remember, SAP was founded in 1972 by 5 guys leaving IBM. They invented the era of Big Iron. You bought a server, you paid SAP $5 million up front for the license, and you owned it. It was yours. Now, under the banner of Rise with SAP, they are trying to move everyone to a subscription model.
So instead of buying the car, you're leasing it forever.
Yes. And investors usually love subscriptions because they are predictable. You know the check is coming every month.
But the transition itself is brutal.
It is. When you move a customer from that high-margin legacy support, that paid-off apartment building, to the cloud, your margins initially drop. You have to pay for the cloud hosting. You're paying AWS or Azure or Google Cloud to host the data.
And all the hand-holding.
You have to pay for the migration. You have to pay for customer success teams to hold their hand. It's expensive.
So they're swapping out the high-profit engine for a lower-profit engine, hoping that eventually the volume makes up for it.
That is the bet. And the framing question for this entire deep dive is about execution risk. Can they swap out the engine of the car while driving down the highway at 100 miles an hour without crashing the profitability? Because if they stumble,
The stock has a long way to fall.
a very long way.
And that leads us directly into the second section of our analysis, because there are signs that the engine might be sputtering just a little bit. Let's talk about the cloud transition and this red flag regarding the backlog.
This is where we get into the weeds, but stay with us, because this is the single most important number for investors. It is the holy grail of forecasting. It's called current cloud backlog.
Why are people obsessed with this specific metric? Why not just look at sales?
Because in the subscription world, you don't get the cash up front. If I sign a deal with you today for $1 million over a year, I only recognize a tiny bit of that revenue today.
Okay.
Looking at today's revenue is like looking in the rearview mirror. If you want to see the future, you look at the backlog, specifically the current cloud backlog, or CCB.
And what is that exactly?
This is the money that is contractually committed to hit the bank account in the next 12 months.
So it's the closest thing to a guarantee you get in this business. It's money that is already signed.
Right. So in 2025, the CCB was $21.05 billion. That was up 25% in constant currency. Sounds great, matches the narrative.
It does. Sounds fantastic.
But then the guidance for 2026 came out.
And the music stopped.
Music slowed down. Management signaled a slight deceleration in the growth rate of that backlog.
Okay, I have to play devil's advocate here. If I'm growing at 25% and then I grow at, say, 22%, I'm still growing. I'm still getting bigger. Why is the market freaking out over a few percentage points?
Because of the valuation. SAP is currently priced as a cloud compounder. Investors are paying a premium high multiple of earnings because they expect that growth curve to stay steep for a long time.
It's priced for that trajectory.
Exactly. It's like a rocket ship.
Yep.
If the trajectory flattens even a tiny bit, the destination changes dramatically.
So if you're priced for perfection, very good is actually failure.
Precisely. If that growth slows, investors stop viewing you as a hyper-growth tech stock and start viewing you as, a mature utility. And utilities trade at much lower prices. That is multiple compression.
Ouch.
You can keep growing earnings, but if the multiple falls, the stock price crashes. That is the danger zone.
That makes sense. But why is it slowing? Is it that people don't want the product? Or is it just math? The numbers are getting bigger, so it's harder to grow at the same rate.
It's a mix of math and reality. We analyze the sources of this backlog, and it turns out the number is a bit noisy. It's managed.
Managed how? Are they cooking the books?
No, not cooking, but definitely seasoning. Take the big transformational deals. If a giant multinational signs a 5-year deal with SAP, they might not start paying the full amount in year 1.
Okay.
They might ramp up. They might say, we will pay you $10 million in year 1 and $50 million in year 3. So that massive $50 million chunk is committed, but it sits in the outer years.
So it doesn't show up in the current backlog.
Correct, because it's not hitting in the next 12 months. The value is there. It's just invisible to this specific metric.
So that could explain part of it. What else?
Then you have government deals. We saw this in Q4. Some government contracts have what's called a termination for convenience clause. Basically, the government can cancel whenever they want. Because of that, strict accounting rules say SAP can't count that money as committed, even if the government is 99.9% likely to pay.
So it's a technicality.
It is. SAP said this shaved about 1 percentage point off the growth rate. But the skeptical investor asks, is it just a technicality? Or is the easy growth running out?
And that's where this gets interesting.
Right. We have to talk about the forced march.
Forced marks. This sounds like a military campaign.
It effectively is. SAP has told its legacy customers, mainstream maintenance for your old software business suite 7 ends in 2027.
Wow.
They've offered an extension to 2030, but it costs extra.
They are burning the ships. There's no going back.
They're putting a gun to the customer's head. Move to the cloud or you're on your own. This creates artificial urgency.
I see the problem.
The worry is that the growth we are seeing right now isn't organic demand, because the new product is amazing. It's just the existing customer base reluctantly switching because they have no choice.
And once everyone has switched, what happens then? Where's the growth?
The growth cliff. Once you've turned your own base, where does the new money come from? That is the anxiety hidden inside that deceleration number. Are they running out of people to force?
That is a terrifying thought for a long-term investor, and it's a perfect segue to Act 3, because if you are going to force your customers to do something they don't want to do, you better have a really, really strong grip on them.
You better have a massive moat.
The moat?
The castle walls. And SAP's moat is legendary. High switching costs, as we said, it runs the nervous system, supply chain, payroll, finance. You don't just rip that out on a whim.
It's not like changing your email provider.
Not at all. It's like trying to perform a heart transplant on yourself while running a marathon.
It sounds like a guaranteed way to die.
It often is. And the horror stories in our research prove this. Look at Lidl, the grocery chain.
Oh, I saw this in the notes. This is a nightmare.
Lidl spent 7 years trying to implement a new SAP system for inventory management. 7 years of consultants, coding, integration. They sank $500 million into the project.
€500 million.
$500 million. And what happened? Did it work?
I'm guessing no.
No. They canceled it. They wrote it off to zero. They went back to their old system.
That is nauseating. Imagine being the executive who has to explain that loss to the board. Hey guys, remember that €500 million? It's gone.
And that's not even the only one. There's the Birmingham City Council in the UK. They actually tried to switch away from SAP to Oracle.
To a competitor.
To a competitor. And that failed spectacularly. Costs ballooned from $20 million to $100 million. The system didn't work. Social workers couldn't access files, and they basically went bankrupt.
Okay, so I'm confused. These stories sound terrible for SAP's reputation. But Doesn't that prove the moat is strong? It proves you can't leave.
It proves you can't leave easily. But it also proves that migration is a death zone. The expert analysis here is that these stories cut both ways.
How so?
If I'm a CIO at a big company and I see Little lose €500 million, am I going to rush to do a cloud migration with SAP?
No way. You're going to delay. You're going to kick the can down the road. You're going to hide under your desk.
Exactly. You might just say, you know what? I'm staying on the old system. It works. I don't want to get fired. But wait, SAP is raising the prices on support for the old system to force you to move.
Rock, meet hard place.
Enter the sniper, the regulators.
This is the part that really surprised me. I thought the EU usually went after Google or Apple or Amazon. Why are they looking at boring old SAP?
In September 2025, the EU opened an antitrust investigation. But, and this is critical, they aren't investigating the software itself. They aren't saying the ERP is illegal.
So what's the target?
They're targeting the aftermarket for maintenance and support.
Explain that distinction. Why does the aftermarket matter?
Think of it like a car. You buy a Ford. Ford wants you to service it at the dealership where they charge $200 an hour. But you want to go to the local mechanic who charges $50.
Sure.
Ford can't legally stop you from doing that. If they tried to void your warranty for going to an independent mechanic, they get sued. But in software, SAP effectively does stop you.
How?
They have restrictive licensing terms. They charge things called reinstatement fees. If you leave SAP support to go to a third-party provider like Rimini Street or Spinnaker Support, who charge half the price, and then you later decide you want to upgrade your SAP software,
They hit you with a massive penalty.
a massive penalty fee. It's
Yeah.
a wall to keep you in the expensive dealership.
And remember what we said in Act 1, that high-margin support revenue is the piggy bank.
That is the cash flow funding the entire cloud transition. If the
Well-
EU forces SAP to knock down those walls,
The piggy bank breaks.
or at least it starts leaking. This is revenue leakage. Reuters reported in November 2025 that SAP is already offering concessions. They're offering to drop the reinstatement fees. They are scared.
So play this out. If I'm a customer and I'm annoyed about the forced migration, and suddenly the EU makes it easy for me to hire a third-party support team for half the price, what do?
You might just stay on your old on-premise software forever. You don't move to the cloud. You don't feed the growth narrative. You just pay a third party to keep the lights on. That is a strategic disaster for SAP's RISE strategy.
And do we have any data on whether customers are actually annoyed, or is that just speculation?
We have the Net Promoter Score, or NPS. In 2025, SAP's NPS fell to 9.
9. Hold on, I need context. What's a good score?
It's on a scale of -100 to +100. A company like Apple or Costco sits in the 50s or 70s.
So, 9 is bad.
A 9 is lukewarm. It's borderline hostile. It suggests friction. It suggests people are using it because they have to, not because they want to.
And unhappy customers during a forced migration window are the most dangerous kind.
Exactly. They are looking for an exit.
Uh-huh.
If you give them a door, like the EU investigation might, they will walk through it.
Okay, so we have questionable profit quality, a decelerating backlog, and a regulatory sniper aiming at their cash cow. Let's move to Act 4. Governance. What are the people at the top doing with the money?
They are giving it back to shareholders,
Mm-hmm.
but in a way that raises eyebrows.
How so?
They authorized a massive new share buyback up to $10 billion starting in February 2026, plus a hefty dividend of $2.35 per share proposed for 2024.
Usually buybacks are seen as a good thing. It means the company thinks its stock is cheap. It's a vote of confidence.
That's the charitable interpretation. That's the fan interpretation.
The skeptical interpretation.
The skeptical interpretation is, why are you buying back stock when the price is at an all-time high? And why are you doing it when you need to spend billions on this cloud transition?
It feels like financial engineering, like we can't grow the business fast enough, so let's shrink the share count to make the earnings per share look better.
It smells like they have run out of organic ideas. And they are still doing M&A. They have $31 billion of goodwill on the balance sheet. They bought WalkMe recently.
So they're spending money on acquisitions and spending massive amounts on buybacks?
It's a very capital-intensive strategy. They are burning the candle at both ends.
And you mentioned something in the pre-show about a trust tax, that investors don't fully trust the numbers coming out of headquarters.
This is a huge pet peeve for institutional investors. SAP has a habit of changing its non-IFRS definitions. This is the moving the goalposts problem.
Give me an example. How do they move the posts?
In 2024, they changed the definition to include share-based compensation, but exclude equity security gains. Okay, fine.
Mm-hmm.
Then in 2025, they changed it again to exclude expenses related to the Teradata litigation.
Wait, hold on. They just decided that legal costs for a lawsuit don't count as operating expenses.
For their adjusted profit, yes. They said, ignore that, it's a one-off. But when you have a habit of finding one-offs every single year that always make the profit look higher,
Investors start to roll their
they
eyes.
start to play a trust discount. It's the I need to check your math fee.
And speaking of that litigation, we can't ignore the legal baggage, can we?
Not at all. The FCPA thing.
Yes, the Foreign Corrupt Practices Act.
In January 2024, SAP entered a deferred prosecution agreement with the U.S. Department of Justice. They paid over $220 million in fines and forfeiture.
What was the charge?
Bribery. Schemes to bribe government officials in South Africa, Indonesia, and other places to get contracts.
Bribery. That's not just an accounting error. That's rot. That's a culture issue.
It is. And then there is the Teradata lawsuit. This is a trade secret and antitrust suit. SAP has already set aside $174 million just for a settlement provision. The trial is looming in 2026.
So when you combine bribery settlements, trade secret lawsuits, and constantly changing financial metrics,
You get a governance risk. As an investor, I have to ask, do I want to pay a premium multiple for a company where I have to constantly worry about what's lurking in the legal department?
it puts a ceiling on the valuation. You just can't pay top dollar for that kind of noise.
You can't. It's too risky.
All right, we've been pretty tough on them. We've looked at the optical profit, the backlog fears, the regulatory risk, and the governance baggage. Let's bring it all together in Act 5, the verdict.
If I'm a bull, if I want to buy this stock, what needs to happen?
If you are a bull, you are betting on a royal flush. You need 4 things to go perfectly right.
Okay, lay them out. The what must go right checklist.
Number 1, cloud durability. That backlog deceleration needs to be a blip, not a trend. Growth needs to stay above 20%. If it drops to 15%, the stock crashes. They have to prove the deceleration was just a math quirk, not a demand issue.
Okay, number 2.
Real margin expansion. They need to show they can increase profits without relying on restructuring cuts. They need to show operational efficiency. The machine needs to actually run better, not just, fire people.
Number 3, support economics. This is the math problem. They are losing the high-margin legacy support revenue as people move to the cloud. The growth in the new cloud profit must outpace that loss.
So the melting ice cube can't melt faster than the snowball grows.
Exactly. If it does, you have a hole in your earnings.
And number 4, the final piece.
Regulatory quiet. The EU investigation needs to end with a slap on the wrist. If the EU breaks the monopoly on support, the pricing power is gone, and the whole model is in jeopardy.
That is a tough checklist.
Yeah.
That is threading a needle while riding a unicycle. So what is the official skeptical conclusion?
Under our framework today, the status is not investable unless proven otherwise.
Not investable. That is a heavy verdict for one of the biggest companies in Europe.
It is. And look, it's not because SAP is going to go bankrupt. It's not. It's a great franchise. It's essential. But the market expects perfection. The stock is priced for perfection.
Right.
But the data, the backlog, the governance, the customer friction suggests very good but messy.
And when you pay for perfection and get messy, you lose money.
Exactly. The risk of that multiple compression we talked about is just too high right now. The downside risk is much higher than the upside potential.
All right, we've covered a massive amount of ground. For the listener who maybe glazed over during the discussion of IFRS accounting, give us the 3 absolute key takeaways to bring to the dinner table.
Takeaway number 1, optical profitability. Do not trust the 111% profit growth headline. It is largely a result of cost cutting and the absence of restructuring charges, not purely explosive sales growth.
Got it. Always ask why the profit went up. What's number 2?
Takeaway number 2, backlog anxiety. The guided deceleration for 2026 is a smoke signal. It suggests the easy growth from forced migrations is ending and organic growth might be harder to find.
And the 3rd?
Takeaway number 3, the leakage risk. SAP is most vulnerable right now. Between the EU regulators trying to open the gates and unhappy customers looking for an exit, the moat is under attack at its most critical moment.
It really challenges the idea that you can just buy blue chip stocks and forget about them.
There is no such thing as a buy and forget stock in the tech world. Tech is a shark tank. If you stop swimming, you die.
Before we sign off, I want to leave the listeners with a final provocative thought, something we touched on but didn't fully explore.
Go for it.
We talked about the EU potentially forcing SAP to open up its support ecosystem, if that happens, if third parties can maintain the software just as well as SAP, and cheaper. Do we see a future where SAP becomes just a code provider? where they lose the lucrative service monopoly that actually built their empire? Does SAP become a utility company selling the electricity but losing the service contract to the local electrician?
That is the nightmare scenario for them. If they lose a service relationship, they lose the customer intimacy. And if they lose that, they're just a vendor of code, and code eventually becomes a commodity.
A chilling thought for a Friday the 13th. That's all for today's deep dive into SAP. Thanks for listening, and remember, read the footnotes.
Always read the footnotes.
See you in the next deep dive.